Meet Alex and David, two friends who are both 25 years old. Each has $10,000 to invest and both share the same dream, achieving financial freedom. Neither wants to spend their lives worrying about money or working forever. They've both heard the classic advice, just invest in the stock market. It sounds simple, but as they start researching, they quickly realize there's more to it. Every website seems to recommend two main options: index funds and ETFs. This is where their journey and our story begins. Alex and David soon discover that the investing world is divided. Some experts swear by index funds, while others claim ETFs are the superior choice. Both friends wonder, if they invest in the same market, which one will actually make more money? The answer isn't as straightforward as it seems. While these investments look almost identical, there are subtle differences that can influence how investors behave, and that behavior can have a huge impact on long-term results. After some research, Alex decides to invest through an index fund, while David chooses an ETF. At first, both feel confident in their decisions. They're both investing in the S&P 500, which means they're exposed to the same companies in the same economy. When Apple, Microsoft, or Amazon grow, both benefit. It seems impossible that there could be any meaningful difference between their investments. But to truly understand, we need to look closer at what index funds and ETFs actually are. Imagine trying to pick individual stocks. Should you buy Apple, Tesla, NVIDIA, or Coca-Cola? The reality is, nobody can predict which company will outperform over the next decade, not even professional fund managers. That's why index funds became so popular. Instead of guessing, an index fund simply buys all the major companies in an index. For example, an S&P 500 index fund owns shares of the 500 largest publicly traded companies in America. With one investment, Alex owns a tiny piece of hundreds of businesses. Index funds are designed to track the performance of a specific market index, like the S&P 500. Instead of trying to beat the market, they aim to match it. This means no guessing, no predictions, and no complicated strategies. For Alex, this approach means broad diversification and a straightforward investment experience. He doesn't need to worry about which company will win or lose. He owns a piece of them all. David's ETF works in a very similar way. His ETF also tracks the S&P 500, owns the same companies, and provides instant diversification. Like index funds, ETFs usually charge extremely low fees. So far, it seems like there's almost no difference. Both Alex and David are invested in the same businesses, participating in the same economy, and benefiting from long-term market growth. If you looked at their portfolios today, you might think they were identical. But then, subtle differences begin to appear. Alex notices that his index fund only receives a single price each day. No matter when he places his order, he gets the closing price after the market finishes trading. It's simple, predictable, and a bit boring. David's ETF, on the other hand, behaves more like a regular stock. Its price moves every second the market is open, allowing him to buy or sell at any moment during trading hours. At first, David thinks the flexibility of ETFs is a huge advantage. He can buy or sell whenever he wants and check prices throughout the day. In some situations, this flexibility can be helpful, but with flexibility comes temptation, and temptation can lead to mistakes. The ability to trade at any moment can make it harder to stick to a long-term plan, especially when emotions run high. A few months later, the market experiences a sudden sell-off. Financial news channels are full of recession fears, and social media is buzzing with panic. Stock prices fall rapidly. Alex checks his account and sees red numbers, but since his index fund only updates once a day, there's not much for him to do. He sticks to his plan. David, however, watches his ETF fluctuate minute by minute, feeling every market move. David's phone constantly reminds him that his investments are falling. For the first time, he wonders if he should sell. Fortunately, he doesn't panic, but millions of investors do. This is one of the biggest lessons in investing. The greatest threat to your portfolio isn't the investment itself, it's your own emotions. History shows that investors often buy after prices rise and sell after prices fall, underperforming the very funds they invest in. The real difference between Alex and David isn't their investment choice, it's how they react during tough times. Investors who stay disciplined and ignore short-term noise tend to do better in the long run. The market rewards patience, not panic. Both Alex and David learn that sticking with their plan is more important than trying to time the market or react to every headline. As time passes, Alex and David discover another reason index funds and ETFs are so popular: low fees. Traditional mutual funds often charge much higher management fees, but many index funds and ETFs cost almost nothing, sometimes as little as 0.03% annually. For every $10,000 invested, that's just a few dollars a year. Over decades, keeping fees low can make a huge difference in wealth creation. Every dollar saved on fees stays invested, and every dollar invested continues to compound. Compounding is where real wealth is built. Over time, the money you earn starts earning its own money, creating a snowball effect. This is why both Alex and David focus on keeping costs low and staying invested for the long haul. Years go by, markets rise and fall, recessions come and go, bull markets return, technology evolves and new industries emerge. Through all these ups and downs, Alex and David keep investing. They don't try to predict the next crash or chase the next hot stock. They simply stay the course, trusting in the long-term growth of the market. A decade passes. Now comes the question everyone wants answered. Who made more money, Alex or David? Surprisingly, the answer is almost neither. Both were invested in nearly the exact same market, owned the same major companies, benefited from long-term economic growth, enjoyed low fees, and received diversification. Their results are remarkably similar. The difference wasn't the investment, it was the investor. If Alex had constantly traded his index fund strategy, he could have underperformed. If David had panic sold during every market correction, he could have underperformed. The real winner was always going to be the person who remained disciplined and stuck to their plan, regardless of market noise. Wealth creation isn't about predicting tomorrow, it's about participating for decades. The market doesn't reward the smartest investor, it rewards the most patient one. Alex and David's story shows that staying invested and ignoring short-term distractions is the key to long-term success. Many beginners spend weeks debating whether to choose an index fund or an ETF. They compare fees, providers, and features. While these details matter, they're often focusing on the wrong thing. The difference between a good ETF and a good index fund is usually very small. The difference between staying invested and quitting is enormous. Alex learned that simplicity works. David learned that flexibility isn't always necessary. Both discovered the same truth. Successful investing isn't about finding the perfect fund. It's about finding a good strategy and sticking with it long enough for compounding to work its magic. Consistency is the secret ingredient in building wealth. By regularly investing and resisting the urge to react to every market movement, investors give themselves the best chance for long-term success. Alex and David's journey proves that the market rewards those who stay the course. In the end, the choice between index funds and ETFs matters less than most people think. What truly matters is having a solid plan, keeping fees low, and staying invested for the long term. The market doesn't reward the smartest or the fastest, it rewards the most patient. So, whether you choose an index fund or an ETF, remember, discipline and patience are your greatest allies on the path to financial freedom.